Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome, everyone, to another edition of SHP Financial's Retirement Roadmap podcast. I'm your host today, Matthew Peck, joined by Keith Ellis. And we have an extra special guest today. Today, we're joined by Bill Stuart, one of the world's leading experts on health savings accounts. He literally wrote the book, and I'm not even joking, no puns or dad joke necessary. He literally wrote the book titled HSAs, the Tax Perfect Retirement Account. I really look forward to talking about the whole tax perfect nature of it, because that jumps off the page, to say the least. But interestingly enough, here's what Dan Perrin, the president of the HSA Coalition, had to say about Bill. If there is a Medicare or HSA question that no one on Capitol Hill or at the White House or at Health and Human Services can answer, I call Bill Stuart. So without much further ado, Bill Stuart, thank you and welcome to the podcast.
Thanks for joining us.
Thanks. Look forward to a good discussion.
Well, I think it's specifically because we were talking a little bit offline. I think there's a lot of questions about HSAs. I mean, maybe it's because we're buried in acronyms, HSAs and IRAs
RMD.
and RMDs. I mean, it is amazing how many of them are out there. But understanding and making sure that people don't overlook what really truly could be one of the greatest opportunities to speak to the high cost of healthcare, and they're not going down anytime soon. So tell us a little bit about your background and how you got into this and how you became fascinated with it, and really looking forward to it.
Sure. So I joined Harvard Pilgrim about 20 years ago. And my job there was to be part of the consumer-driven health revolution. And I didn't know what that meant when they first approached me. And it was all about health FSAs and health reimbursement arrangements, which had just been brought into law in 2002. And then in 2004, HSAs were launched. So I came in as sort of an expert that could support the sales force, as well as employers and employees, in talking about the federal tax code and how health savings accounts work and how they can make a difference in people's lives. So I did that for 12 years, and then one of my vendor partners hired me away, an administrator of these accounts, and I've been working on the administration side ever since.
And so now, were you in policy or in government, or had you worked for health insurance before Harvard Pilgrim?
Yeah, I'd actually worked a previous stint at Harvard Pilgrim. So they knew me and I knew them and I knew the insurance world, but the whole idea of these health accounts was brand new to me.
And so literally they're like, okay, Bill, come here, figure it out.
Yeah, that's pretty much it. Come in, there's no script, it's a newly created job. We think you can handle this. Prove us right.
Yeah, absolutely. Okay. And then one last question about the history, and then we'll kind of dig into the actual account itself. So when it passed in 2004, was it, I guess, what was the logic and what was the spirit of the law when they passed and created HSAs?
Yeah, good question. They actually go back to the mid-90s. As part of a previous law, they created this program for small businesses. It was a pilot program where it was a tax-advantaged account and the employer could put some money into it. Fast forward to 2003, and there was a big move in Congress to create a prescription drug program under Medicare, which we now know as Part D. Mm-hmm. And that legislation was formulating through 2003. And some of the people who were involved in that pilot program said, let's also take that program and turbocharge it and make it part of this. And that helped bring a coalition together to pass the prescription drug program. So at the very end of 2003, we had health savings accounts that were no longer a pilot program. They were now available to everybody, including people who were buying in the individual market. They now allowed an employer or employee contribution and a lot of other features to it. So 2004 was when they launched. So we're really celebrating the 20th anniversary of these accounts at this point.
Interesting.
So tell us a little bit about what an HSA is. And another acronym that you did throw out there was FSA. So maybe we get, so many people confuse those two things. Maybe you could expand upon the difference between them.
Yeah, and that's one of the great frustrations that we have in the industry, including a lot of us whose companies represent both of those accounts. And they're both great in the sense they both allow you to pay qualified medical, dental, vision, over-the-counter expenses with pre-tax dollars. Mm-hmm. So the tax savings are equivalent on the two. But there are a lot of limitations that a health FSA has. Health FSA stands for Health Flexible Spending Account, and yet it's really much less flexible than the health savings account. And then the big area of confusion, I think, number one, is this idea with a health FSA, if you don't use the money by the end of the year, you forfeit your remaining balance. And employers do have an opportunity to allow you some extension of that, okay, but it's very limited. Essentially, you need to spend your FSA money year to year. It's an annual reimbursement program. A health savings account, in contrast, think of it as your checking account, as your retirement account. That money continues to grow year after year. There's no requirement you deplete the account at the end of the year. There are no limits to how much you can have in the account over time. There are limits to how much you can contribute each year, but that money remains in the account until you spend it, whether that is next month or next year or 30, 50 years down the road. So that's the number one difference. There are some other differences that are really important. With an FSA, you are locked into an annual election. So before the beginning of the plan year, you've got to kind of figure out how much are we going to spend on dental, vision, and medical. And if you're right, that's great. If you overshoot, you can forfeit. If you put in too little money, then you're going to lose tax savings during the course of the year. With a health savings account, you can change your contribution level as your needs change during the year. So another flexible piece there. Also, a couple of other quick things. Health savings accounts, you can earn interest on the money, you can invest it, and you can leave it to an heir. So when you die, the account doesn't die. It's actually a trust. And as your listeners know, because you've taught them, trusts don't die. Yes. They are transferred to somebody at your instruction at your death. So they are transferable, so you don't lose the value of a health savings account just because you're no longer here.
Go ahead, Keith. Yeah.
Another benefit that I hear quite a bit is the term triple tax-free.
Yeah.
Can you elaborate on that maybe a little bit?
Yeah. So the beauty of this is, and your listeners who are used to retirement accounts know that usually you're going to get taxed on either the front end or the back end. And that question is always, do you want to be taxed on the seed or do you want to be taxed on the harvest?
That's a great way to put it.
Yeah,
absolutely.
With health savings accounts, you don't face either. So contributions made to a health savings account are not included in federal taxable income. They're not included in state taxable income unless you live in California or New Jersey, but the other 48 states either have no income tax or they've exempted HSA contributions. And you also pay no payroll taxes if you contribute through your employer's pre-tax payroll program. So the money goes in tax-free. It accumulates tax-free, so the growth, like a typical retirement account, you're not taxed as that account appreciates over time. And then when it comes time to distribute money, you need to spend it. That will not be taxed as long as you use it to pay qualified expenses. So tax-free going in, tax-free accumulating, tax-free coming out.
So hence the tax perfect. Is that the when the title of your book being tax perfect? Is that has to meet that definition? Huh?
That's right.
Sounds good to me.
Right.
Yeah. We talk about tax preferred accounts, and that usually means that it's tax deferred.
Right.
Like a tax deferred 401k, but
preferred and deferred they use a lot. Right.
But whether it's a tax deferred or a Roth, you're paying at one end or the other.
Correct.
Tax perfect means you can avoid all the tax friction on a health savings account.
Yeah. I wanted to let that resonate a bit. Again, all taxes. So two things though that we'll kind of wanted to jump back to too. You mentioned about qualified expenses. So is it, and I'm sorry to muddy the water again between FSAs and HSAs, but is a qualified medical expense the same under both of them, and if not, that's okay. Let's just focus on what is a qualified medical expense. I mean, how do you pull money out of an HSA if it in fact grows tax-free, tax perfect, and tax not on the way in, et cetera. But how do I access it, and what can I use it for?
Yeah, great question. And the answer is, for your listeners who have used a health FSA for years, it's the same list. Health savings accounts also pick up some premiums in certain cases, but those medical, dental, vision expenses, they are the same. So a qualified expense is anything that basically prevents, treats, or cures an injury, illness, or condition. So it has to be that. It has to be a qualified family member, which means you, your spouse, or a tax dependent. And it has to be incurred on or after the date that you first set up the health savings account. So it passes those three filters, then it is an expense qualified for tax-free distribution.
Is there a list, sorry to interrupt, Bill, is there a list that people can easily reference? Does the IRS.gov kind of put out a list just for just for people like, okay, I didn't realize that this was covered, like eyeglasses. I don't know if eyeglasses are or are not. I mean, I have some background in Medicare where they said like, okay, that qualifies for Medicare, but that doesn't, and sometimes it was silly, like a routine physical, you'd get one. And I'm not sure if they've changed that. I know that was back in the day. So is there a list that people can reference just so they know, okay, great, this is covered or is not covered?
Yeah. Let me give a resource, and then let me talk, because you've opened another box here, which is really important. The IRS puts out a publication called Publication 502. Just Google IRS Publication 502. It's about a 20-page booklet that describes qualified expenses. Also, if you have a health FSA or have a health savings account, your administrator online probably has a quick alphabetical 1 or 2 page list that gives you a really good idea of what's a qualified expense. But you've made a really important point when you talk about what Medicare covers and doesn't cover, and medical plans for pre-retirees are the same. A Blue Cross plan or a .32 plan isn't going to cover everything possible. But a health savings account list of qualified expenses is broader than what the medical plan covers. For example, my medical plan doesn't cover my foot orthotics. Those are a qualified expense because they treat a particular condition. My feet aren't aligned properly. Acupuncture is often not covered by a medical plan, but we assume that's used for the management of pain. Most people aren't going to pay somebody to stick needles in them for no reason. So that is another example of an expense. Chiropractic used to not be covered by insurance. It generally is, but let's say your insurance covers 12 visits and you need 20 over the course of the year, then those last 8 you can reimburse out of your health savings account because that is a qualified expense. It's treating a medical condition. So it's much broader, that list of qualified expenses, much broader than medical. Dental is another example. Frequently, adult orthodontics is not covered by a dental plan, but that is treating the malalignment of teeth. That is a qualified expense. You can reimburse 100% of that out of your health savings account.
That's fascinating.
And that's one of the biggest expenses I hear. As retirees, folks come in all the time and say, I had a massive dental cost. So if you could start putting money away in your HSA to start to save and pay for these expenses, later in life, it is a huge advantage in my opinion. You know, the question I have is, you know, we've talked a lot about HSAs. Obviously, we've defined what they are, kind of how they work. Who offers them, or who can get them, and how do you get them?
Yeah, now you've opened another door. But
I'm sure that's where the listeners are at.
I like opening these doors because we're getting a lot of great info and a lot of great tidbits from you.
Yeah, and it's a really important door to open. So you need to be enrolled in what unfortunately under the legislation is called a high deductible health plan. We in the industry call it an HSA qualified plan because number one, that sounds a heck of a lot better. And
people hear high deductible and run, right?
Yeah, right, absolutely.
Yeah, they tend to run for the hills. And also because high deductible health plan has become a very generic term these days. So your medical plan for 2023 has to have a deductible of at least $1,500 if you cover only yourself, and at least $3,000 if you cover one other family member. So a family plan, $3,000, individual, $1,500. Also, everything except preventive care must be applied to that deductible. So if you've got a plan that has a $2,000 deductible, but it has a $25 copay for a sick visit at the doctor, that is not a qualified plan. Most plans are going to say HSA in their name. You know, the Best Buy HSA 3000 plan. But be sure to ask your insurer or your employer if your plan is an HSA qualified plan. If it is, then you need to meet two other requirements in order to open and fund a health savings account. You can't be someone else's tax dependent. Most of our listeners, that's probably not a problem unless you're a 10-year-old that really gets into finance and wants to learn from the SHP podcast. But generally, that's going to be fine. And you can't have any other disqualifying coverage. The two biggest areas we run into here are, number one, a general health FSA is disqualifying. So if you or your spouse is enrolled in a general health FSA, you cannot set up a health savings account. And number two is Medicare. So if you are a working senior and you are enrolled in your company's HSA qualified plan and meet all the other requirements, but you also took Part A at age 65 or when you started collecting Social Security benefits thereafter and automatically enrolled in Part A, you can no longer fund a health savings account. But absent that, you are enrolled in the right plan, you can continue to make contributions forever.
And walk through that part. So you enroll because I'm happy enough, or this is very important here too, or because I have an HSA. I think Keith, you have an HSA too. Yeah. So he and I have an HSA. But just for our listeners, what I recall is that you pay your premium. I continue to pay my premium to whomever, the health insurance is, but then separately I go on to a separate custodian to then make the deposits in, and then another, almost like a third custodian then manages the assets, because you can invest the assets, correct? So is that, I'm not sure if that's how it was before, if they've streamlined the process a little bit, but it's almost like you pay a premium and you do a deposit or a contribution, forgive me, separately. And they're separate.
Yeah, so when you're working through your employer is going to deduct from your pay your portion of the premium. And generally when the employer is offering multiple plans, the premium for the HSA qualified plan is less. Mm-hmm. So you get an immediate break right there. It may be $200 per pay period versus $300 being taken out for your premium. And then, yes, separately, there is a contribution that you can make to the HSA, usually done through pre-tax payroll contributions. So you just tell your employer, take $200 per pay period out of my paycheck, or I want to put in the maximum for a family, which for me is $77.50 this year. Divide that by 24 pay periods, and I'm putting in almost $300 plus per pay period. The employer's collecting that money and then sending that on my behalf directly to my HSA administrator, plus any money the employer's putting in. So the employer is allowed to put in a contribution as well. So that money is going into my health savings account, which is managed typically by someone other than my insurer. So there are a number of HSA administrators out there. There are thousands of them. Some of the big names are HSA Bank, Health Equity, Fidelity, Optum. Those are names you might see that your employer is working with. And then you log on to your account there, and you can see your balance. You're going to get a debit card where you can pay your expenses. There's going to be some kind of investment account associated with most health savings accounts. Sometimes it'll be a menu of mutual funds, a couple dozen mutual funds. Sometimes it'll be a brokerage account where you can invest in any stock, any mutual fund. So that's the way it works. So that you've got the medical insurance, and then separately you have this financial account.
I see. Okay, so just again for our listeners, and maybe that's where the differences were, because being self-employed, so it's like it's obviously different. If it's offered through your employer, it's almost being all taken care of for you to a certain extent.
Yes.
Right. Whereas obviously if you're self-employed, you do have to kind of maybe take an extra step, because you're both the employee as well as the employer, to make sure you get that second contribution in. So slightly different steps or things you need to do, but whether you're an employee or self-employed, obviously we wouldn't be doing this podcast if we didn't think you should be looking into it. But Keith, before you have another question, I do want to go back to, because specifically for a lot of our listeners are on Medicare. Can you walk through? So you had mentioned that people that are on Medicare obviously can't enroll, they can't continue to contribute into it. But let's say you have an HSA and you're going on to Medicare. And now I know the HSA is now stagnant and you can't contribute anything more, but how can you use your HSA? How can you apply your money in HSA to Medicare expenses? Is it? I've heard it's just Medicare Advantage, and yeah. So try to straighten us out there as to what happens when you have $50,000 in your HSA and now you hit Medicare.
Yeah. The beauty is that you've got a lot of options here. So as we mentioned, once you are enrolled in any part of Medicare, you can no longer contribute. But you have the account, you have the balance, it's still yours. So what can you spend it on? Well, Medicare Part B is going to have premiums, and they're $160 or so per month or higher this year. They typically go up every year. That can be paid out of a health savings account. If you're collecting Social Security, Part B premium is going to be deducted right from your Social Security check. So you can write yourself a check for $160 every month, or $161.20 or whatever it is. You can write yourself a check. You can transfer money into your personal account every month if you want to do that. That is a tax-free distribution from your health savings account. Part D, the prescription drug, is also going to have a premium. That also is reimbursable, tax-free out of your health savings account. If you are on Medicare Advantage and that has a premium, many plans don't, some do have a small premium, that is a tax-free distribution. If you are on traditional Medicare and have a Medicare supplement plan, MedSup, MedX, that premium is not a qualified expense. So you would not be able to take money out of your HSA for that without paying taxes on it. But in addition to the premiums, Medicare has deductibles, it has co-pays, it has co-insurance, it has items that it doesn't cover. We talked about dental. I think that's a big shock for people going into retirement. They always had a dental plan at work. They had a vision plan. And suddenly they realize that most of those services, unless there's a medical component, is not covered by Medicare. So they suddenly have that big bill that you mentioned a minute ago, that for a bridge or a crown or a root canal, they can reimburse that out of their health savings account. And in most cases, it's as easy as taking the debit card associated with the health savings account and handing it to the doctor, the dentist, the vision center. The HSA debit card is either a MasterCard or a Visa. It works on any system, so the doctor doesn't need to have a special health savings account swipe box. It just goes through the Visa or MasterCard system, and the money is just taken out of your HSA rather than your personal checking account.
That's fantastic. And I know you said we're going on close to the 20-year anniversary of HSAs. My question was, how big are HSAs? Like, does every company offer them? You know, are they becoming more and more popular? I kind of give a little bit there, if you don't mind.
Yeah. Not every company does offer them,
Okay.
but most of them do at this point. Some smaller companies might not, but most companies with 100 or more employees that are offering 2 or 3 plans, typically an HSA option is one of those plans. So they are widely available, and that availability is growing every year. There are about 37 million of these accounts out there with total assets of more than $100 billion. So for your listeners who are saying, this is a new concept to me, I wonder whether it's a little bit risky getting into something new. They've been around 20 years.
There's a lot of adoption.
37 million people have gone on to this. There's $100 billion in there. Those numbers grow by about 8 to 12% annually, both the number of accounts and the balances. So they are a tried and true program. If you do the simple math and look at 37 million divided into 100 billion plus, the average account balance is $3,000 mathematically. But that paints a very distorted picture. About half the accounts have $500 or less in them. And what that typically means is people are funding them to the level of their need. So they know they're going to need a couple $1,000s this year, they put in a couple thousand. If they suddenly need more, they can put in more. But they're using it much like the old health FSA, where the money goes in and the money comes out.
Right.
There are about 13% of those 37 million accounts that have balances of more than $2,000. Only about 7% of account owners are investing right now. Their average balance is about $16,000. So there are a handful of people who are using this as a retirement account, as a savings account. They're maximizing what they put in. They're minimizing what they take out. They're building those balances over time through contributions, through investments, and they're really seeing this as another retirement account just for those medical expenses. You know, Fidelity every year does a survey of what it's going to cost for medical expenses in retirement, and for a 65-year-old couple retiring this year, they can expect to pay $315,000 through the remainder of their life, which is roughly 18 years for men and 20 years for women. So $315,000, and that's the Medicare premiums, that's the Medicare cost sharing, the components that Medicare is not covering. It does not cover long-term care, which is a whole
different
can of worms.
Yeah, right.
But just the medical expenses, roughly $315,000. Health savings account is a way of offsetting those, where if you put that same money into a tax-deferred 401k, you'd have roughly the same amount of money, but every dollar taken out of the 401k is going to be included in your taxable income.
Right.
HSA, that money's coming out tax-free. So the same contribution 20, 30 years before is going to buy more in retirement because you don't have the tax friction at the end with a health savings account.
So it's interesting though. So only 7% of account owners are actually setting it aside to build and to grow. I mean, I know we're generalizing here,
right.
But only 7%. So I guess that's part of your advice to our listeners there, is to say, hey, really try to get your contributions as high as possible and your distributions as low as possible with an eye towards retirement.
That was going to be my question. Is it maybe a lack of education on how to use these things?
Absolutely, lack of education. And, it's like anything else in the financial world, and you at SHP deal with this every day. The people who understand things, who are armed with knowledge, end up in a much better situation financially.
Yeah.
And that's all about what you're teaching them.
Yes.
That's separating them from the average person they're walking past on the street. And it's the same way with health savings accounts. It's all about education and understanding that these are so much more than the health FSA annual reimbursement account. And I don't say that to knock health FSAs, because they are a great account for current expenses, and many employers will offer them and not a health savings account, and they're a great way to save money. But understand, if you have a health savings account, you've now got a financial Ferrari in the garage, and you can use it in so many more ways than you can an annual reimbursement plan. So think about, where do I put my next dollar that I want to invest long term? It may well be that belongs in a health savings account rather than a retirement account. I wouldn't tell people that's a universal dictum, but it's certainly something to consider as they look at their overall long-term and retirement planning strategy. HSAs can fit in here very nicely because they are a long-term account. There is no use it or lose it. There is no requirement they spend that money at any particular time. There's no limit on how much they can accumulate in that account. And there are no required minimum distributions once they reach that magic age. So they don't have to worry about, oh my God, I've got to take $10,000 out this year. The government tells me I don't have the expenses, but I need to take it out. No, health savings account, only you, not Uncle Sam, will ever tell you how much you need to take out of your HSA in a given year. It's based on your need, not a formula by the IRS or anyone else.
So it certainly bears repeating. No RMDs on HSAs. But to go back to one, a couple last things before we wrap up. We talked about how with an IRA, so let's say someone is behind the eight ball, says this is great. I'd love to get my HSA as going as possible, sort of accelerate it. There is a rule that you can roll an IRA into it, or what are those rules of consolidating, or is it possible?
Yeah, that's a really good strategy to consider. If you are particularly later in life, you suddenly at age 55 have an HSA for the first time, and you're thinking, how am I going to get enough money in there in the 10 or 12 years before I retire? One of the options you have is a once per lifetime rollover from an IRA into a health savings account. Now, it's a great option because in many cases, most cases, that IRA is going to be tax deferred, and you can take that money out of a taxable stream and put it into a non-tax stream. That's the beauty. There are a couple of restrictions around it. First off, it's not unlimited. You can put in no more than your annual contribution limit. So in 2023, the most you can put into a health savings account, if you cover only yourself, is $3,850. If you have a family plan, you cover at least one other person, the most you can put in is $7,750. In addition, there's a $1,000 catch-up contribution. So in my case, in my family, it's $7,750, plus I've got a $1,000 catch-up. My wife has a $1,000 catch-up, so $9,750 total that we could put in. So you can't roll over from an IRA any more than your contribution limit for the year. Once you do that, you have to remain HSA eligible for 12 months.
Okay.
If you don't, then the whole thing is treated as a premature distribution from an IRA and potentially subject to taxes and penalties. But,
so someone should be real careful, specifically getting close to Medicare. So thinking like, oh, I'm 64, this would be great. But although HSAs are used very nicely towards Medicare expenses, they're not HSA. Medicare plans are not themselves HSA eligible.
That is correct. So yeah, once you're getting close to that magic 65 age, you better rethink that strategy. Unless you work for a large company, you are going to continue on the company plan. You are not collecting Social Security benefits, therefore you're not enrolled in any part of Medicare. You can remain HSA eligible. But otherwise, just be very careful of that looming Medicare enrollment date, because that will disqualify you. And if you wait until after you're 65 to enroll in Medicare, and eventually you do, that Medicare Part A coverage is going to go retroactive 6 months. Mm-hmm. So if you think that your Medicare is starting in November, that Part A is going to go retroactive to May, so you've lost 6 months of HSA eligibility and contributions you thought you might have had.
Yeah, so certainly be careful. Sorry to interrupt, Bill. Certainly be careful there. So my last question is, not to end on such a morbid topic, but to walk us through what does happen at death. So you do have an HSA. You haven't used it for whatever expenses may have been at that point in time. So now you get hit by the proverbial bus. What happens?
Yeah, the answer is the money is not lost. I think that's the first comfort here. The money is not lost because it is in a trust that is separate from you, and trusts don't die. You name a beneficiary during your lifetime. If the beneficiary is your spouse, that money passes to your spouse tax-free. So it'll roll over from your HSA into an HSA that your spouse establishes. Your spouse may already have one, in which case the money can go over easily. If your spouse doesn't have one, your spouse can open an account, even if he or she is not eligible. So you're 75, your spouse is 70, you're both on Medicare, you die. Your spouse can open an HSA to receive that money. And then once it's in your spouse's account, he or she can use it for him or herself and any remaining tax dependents. If you name anybody except your spouse, you want it shared equally by your kids, your dog, your church. You can name anybody else as the beneficiary. If it's not a spouse, then upon your death, it will cease being a health savings account. The investments will be liquidated. The money will go to the recipient that you designate, that beneficiary, and that beneficiary could owe taxes on it. So if it's your kids, they're going to pay taxes. If it's your church, they're not. So that it loses its tax protection. It loses that ability to continue to reimburse expenses tax-free. On the other hand, if I'm giving it to my kids, they're happy to get less money and have it spent on anything they want because the last thing they're thinking about is their medical expenses 40 years from now.
Right, absolutely. Yeah. That's somebody else, that's my future self's problem. That's not my problem right now.
That's right.
So where can our listeners learn more about HSAs?
Actually, the IRS has some good information on its website. Or a simple Google search of health savings accounts will give you some really good information. I mentioned IRS publication 502 earlier. That's a good list and description of the eligible expenses. IRS puts out another really good publication called Publication 969. Again, IRS Publication 969. It's available if you Google. And it is about a 6 or 8 page summary of all the rules of health savings accounts. And also, I'll shamelessly endorse my book once again.
Please do.
HSAs, the Tax Perfect Retirement Account, which is available on Amazon. I'm the author, William G. Stuart, Stuart. You can also follow me on LinkedIn. I write a couple of articles every week on health savings accounts, and that's just William-Stewart, again, Stuart-HSA-Guru on LinkedIn. So William Stewart, HSA Guru, will get you to my account. Follow me, and you'll see me regularly posting my own information as well as posting other people's information on health savings accounts.
Oh, thank you so much, Bill.
Yeah,
I mean,
thanks. Really appreciate it.
I mean, a complete wealth of knowledge in this particular area. And it's funny, Keith, I often talk about how when the government does sort of pass laws or create these accounts, or whether it's the Secure Act 2.0 or any new sort of innovation that is coming out from the American government, it's not necessarily their obligation. So that they've done their obligation, which is to pass the law, which is to create the account, which is to give people that tool,
the opportunity. Yeah.
But it's not their obligation for them to take up on it. Do you see what I mean? And so this is our job. And Bill, that's why I thank you so much. And this is the job of a financial planner and an advisor, is to make sure that you are using every tool in the toolbox on behalf of your client. And when the people walking down the street don't have that knowledge or don't have that good advisor that's making sure that they're taking every advantage, then they're the ones that fall behind. And so, Bill, again, that what you've brought to the podcast today just is in that same spirit. I mean, yes, obviously we're trying to keep lights on and put food on the table. So yes, this is a for-profit company, but we also know that good information begets better information, just a better situation for our clients, their kids, long term. And again, can't thank you enough for coming on. So, Bill Stuart, HSAs, the Tax Perfect Retirement Account. Definitely check it out on Amazon. And thanks again.
My pleasure. Thank you.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button. so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.